Implied volatility is a big factor in setting the price of an option contract. Implied volatility, IV, is a measure of how much a stock's price could change in a year. It is information that comes from the options market for the underlying. When investors buy options, their prices go up, which means that implied volatility goes up. When they sell options, prices go down, which makes implied volatility go down. IV is given out once a year, and there is a 68.2% chance that it is correct, one standard deviation. IV is called a fear gauge, because when IV goes up, it usually means that investors are buying options to speculate or protect their long, short stock positions because the market is uncertain. If a stock's IV is high, it usually means that option prices are trading at a higher premium than they normally would. This means that big price changes in the stock shouldn't be a surprise. On the other hand, if a stock's IV is low, it usually means that option prices are trading at a lower premium than they usually would, so the stock's price not moving much shouldn't be a surprise. High IV stocks don't always move, and low IV stocks can have big moves, so it's important to remember that nothing is certain. IV helps us understand what the market thinks the stock price will do in a certain amount of time. It's important to remember that option prices, not IV, determine IV. If you compare two underlyings with the same stock price and find that the ATM options for one stock are trading at a much higher price than the options for the other stock with the same expiration, you know that the stock with the higher premium must have a higher IV. Take a look at the following examples. If XYZ stock is trading at $100 and has an implied volatility of 20%, the annual range for one standard deviation is between $80 and $120. This sounds complicated, but all it means is that based on the prices of the options, the stock has a 68.2% chance of landing within the range IV is showing, which is 20% above or below the current stock price, or 40 points in this case. Since this is true for most, but not all, situations, there is still a chance that the stock price will be higher than this range. This is why this is not complete information. Even so, it is still pretty accurate and helps us predict how the stock price might change and whether options are trading at a high or low premium. If XYZ had a 40% implied volatility, which would mean it could move between $60 and $140, the options in this 20% IV market would be trading at a lower premium. Because there is even more uncertainty when the IV is 40%, the prices of options must go up. When the IV is high, there is more fear on the market that the underlying could move a lot soon or has already moved a lot. The implied volatility is always changing because the prices of options are always changing. A 40% environment can quickly become a 20% environment, and vice versa. Implied volatility is not a guarantee, but based on the prices of options on the market, it gives us a good idea of how the stock might move. As option sellers, we look for high implied volatility. When IV is high, it means that the prices of options are high compared to how much the stock is worth. We can see how premium levels affect IV by looking at XYZ in two different situations. In the previous examples, we compared a 20% IV to a 40% IV to show how much the price of the underlying is expected to change. When we look at selling a put for $95, which means we may have to buy 100 shares of stock, we can see that the 40% IV environment gives us twice as much credit as the 20% IV environment. Even though we think the price could move more, we get paid for this implied volatility in the form of an extrinsic value premium. Everyone likes getting paid. If I want to buy 100 shares by selling a put, my break-even price is better when implied volatility is high, at $88, than when implied volatility is low, at $91.50. Even though I'm worried about moving, my financial risk is lower because I'm getting more extrinsic value premium. The closer an option is to the stock price, the more premium I can get from it if the IV is high. Let's look at a different situation. Let's say that my lucky number is 350 and all I want is $3.50 from a trade. When you look at the two environments and realize that the 40% IV has a much higher premium at the moment, you can see that I might be able to move my strike further out of the money to get the same $3.50 as in the 20% IV environment. Now, my strike is at 90, my break-even is at 86.50, and I have a lot more room to be successful. As you can see, a high IV environment gives you a lot of freedom. Also, because IV changes over time, we could see that 40% IV drop all the way down to 20%. This would show me that the prices of options have dropped by a lot. The good thing is that I've already locked in the 90 strike put, and if IV goes down, that could make the price of my strike go down a lot. If this happens, I might be able to get out of the trade for a nice profit in a few days, which opens up a lot of new possibilities. When trading implied volatility, we don't always have to wait for stocks to move in our favor or for time to pass. Because of this, we'd rather sell at 40% and see IV drop to 20% than sell at 20% and see IV rise to 40%. This is why we sell options in situations with high implied volatility. The past shows that when IV goes up a lot, it always goes down at some point in the future. We prefer to sell premium instead of buy it because of the research we've done on option prices and the stock movements that happened during the time the option was being sold. We looked at 18 years of S&P 500 data to see if historical, realized, volatility or implied volatility was higher. Using the 30-day implied volatility of the VIX and the 30-day real movement of the S&P 500, we found that implied volatility overstated realized volatility 83% of the time. This means that most of the time, the prices of options were too high compared to how the underlying assets moved, which helped the seller in the long run. Many people who don't like selling options say that it's a zero-sum game, which means that we should break even in the long run. However, that assumes that the option pricing model is perfect and that implied volatility equals realized volatility, which our research shows isn't usually the case. Thanks for watching. Please leave a comment or question below. Click like and subscribe.